Hey, Courtney Smith here, and I've got a bit of a change in strategy here. Not a bit of a change, a big change. Basically, we have a proprietary seasonality indicator, and it turned bullish on Monday, today. And that means that we're going to be playing this market much stronger from the bull side now. Now, we had been looking for a pretty big dip in September, October, and that doesn't look like it's going to occur. We did see about a 10% correction, so we still got the down move we were looking for. It just wasn't the magnitude that we were looking for. Now, that bear market, it's still going to come. Why? Because the conditions that are going to cause it are getting worse, not better, worse. So we still see federal government getting more in debt. We see state and local governments getting more in debt. We see corporations getting more in debt. And we see individuals getting more in debt. Well, that's unsustainable, and it's going to cause a significant bear market. But in the short run, our proprietary seasonality indicator says that the market's going to go higher, and probably much higher. So what we do is, when we get into this seasonally bullish period, we take bigger positions than we normally would. So for example, if normally you'd buy 100 shares of a particular stock, we'd recommend looking at 150 shares. Okay, so maybe 50%, maybe 100% more shares than we normally do, because now our positions are actually lower risk because we have this tidal wave of the bull market, of the seasonality, causing the market to move higher. Well, we're going to surf that tidal wave, and as a result, it's going to move everything higher. But it also means that because of that tidal wave, we actually have less risk in our positions. So we need to actually increase the risk to get it back to normal risk. Okay, now the big bear market, still think it's going to come. We got the dip, it just wasn't as big. So we're just going to have to be a little bit more patient. What could trigger it? I'm afraid it could be the election. You see, Joe Biden is talking about raising taxes. Now, he's saying only on people over $400,000 a year, but that's not the important tax. Raising taxes on corporations. Corporations don't pay taxes. We, the consumer, and the workers pay corporate taxes. So he's got that wrong. But here's the killer tax. The killer tax is capital gains tax. Capital gains tax is a tax on the money you make in the stock market. Now, right now, the market is not taking that into account. But if we see a rise in capital gains tax, and Joe Biden's talking about almost a 100% increase in capital gains tax, like about 90%, then that's a tax on capital. And of course, the stock market is 100% capital. So it reduces the value of the stock market, and therefore the stock market has to go into a bear market in order to compensate for the increased taxes, because that capital is not worth as much anymore. And therefore it has to go down in value. So that may be a trigger out there. We need to be very, very cautious about that. Right now, the market's not selling off, even though I think the market thinks that Joe Biden's going to win, but they're not selling off. So we need to be very, very nervous, but we need to be very, very long. We'll talk to you later.